without further ado, if I could invite Jonathan Tudor from the Clean Growth Fund, Patrikas Feiferas from Contrarian Ventures, Bilal Ahmed from Octopus, and Glenn Morgan from Skies 50 to come up and join me on stage. And Glenn, seeing as you're at the far side, do you want to introduce yourself first?
Yeah. Hi, good afternoon, everyone. Hopefully everyone's got... sorry, was that you or me? I just...
I think you need to swap name badges. You can go, if you've seen you started, Bilal, you can go.
Yeah, thanks. Sorry. Bilal Ahmed, I'm a senior investment manager at Octopus Energy Generation. We are not a VC investor, so we are a growth capital and infrastructure investment fund. We manage capital on behalf of pension funds and other institutional investors across a number of funds, and I lead the work we are doing in the sustainable fuel space. Thanks, and sorry for jumping the gun.
Patrikas?
Yeah, so we are actually a venture capital fund investing in early stage startups all across Europe and Israel, primarily focusing within climate tech. In our firm, we invested in one novel technology developing SAF out of methanol called Metafuels, but then we also done a bunch of work on software side of things, invested in a company called Choose, which is like transactive layer, enabling and facilitating the SAF transactions. So looking forward to the discussion.
Hi everybody, I'm Jonathan Tudor, I'm a partner of the Clean Growth Fund. We're a UK-based, early stage, fairly broad climate tech investor, which would include aviation fuels and other sustainable biofuels as part of that. We only have actually one biofuel investment in the portfolio, which is more of a bio-crude to be refined into SAF and other transportation fuels. That's me.
Yeah, hi, I'm Glenn Morgan. We're Skies 50. I'm a partner, lead founding partner there. We're a specialist in sort of a unique financing company. We're dedicated to aviation sustainability, hence Skies 50. We're dedicated to KPIs. One, to get to aviation to net zero by 2050, hence the 50 in the name, and two, to get a return for our investors. We're slightly different in terms that we will go across all stages of funding, so we can go from a very early stage seed level at like an accelerator level, so very, very early high risk type areas, right through up into the infrastructure-led side of things. So we're uniquely positioned ourselves into that space.
We've had a lot of conversation over the last 2 days about the struggles of getting FID and the challenges that has, but we're going to sort of take it slightly earlier in that journey and look at sort of the more earlier stage, sort of pre-growth and that growth stage. So what makes SAF an interesting investment opportunity when you're looking at it from a sort of venture capital early stage versus other, emissions reducing opportunities that are out there?
I mean, I can kick off, and it's very simple. $4.7 trillion transition problem. It needs to happen.
Do you see that as an opportunity, not a problem? Should we change that to 4.7 trillion?
We put two KPIs into place, which is get aviation to net zero by 2050 and get a return. Anyone would be kidding themselves. You can find projects that do one KPI, either deliver all the green molecules in the world, but it's just not viable financially, or you could do a very financially viable thing that's not producing the green molecules, right? We've set ourselves a target, which is to get right there, which is to make both. So, we've just been grown up about it. You need to make a return for risky investments on that front. So, but, the addressable market is huge. It is very big, but it is very capital intensive, which is slightly different from where a VC would typically look.
I mean, I wouldn't say it's any more or less attractive than some of the other sectors. I think that the slight difference is for a short-term advantage is there's a lot of regulation coming in, which is, it's drawn the line in the sand. And then for entrepreneurs and founders, they love being able to solve problems. So there's a very concrete problem defined, which compels people in an economic sense to engage. Right, so that does make it slightly more attractive. The challenge is going to be is how long will those economic incentives be in place, and can we trust that the regulators aren't going to change their mind in the near or the short term, which means we get the carpet pulled under our feet?
I think so I would agree with all of the above. The other angle I would add from the Octopus side is we are historically have invested quite extensively in renewable energy generation across the development, construction, and operational stages. So we've got many gigawatts of generation capacity across those three categories. So we see investments in this space, particularly on the e-fuel side, as a route to market for some of the electrons that we're investing in.
Patrikas,
I can wrap this up. I think good points by everyone. I think for us, I mean, we invested in another hydrogen company. We looked at a bunch of stuff on carbon side of things. I think key two things for us is one, it's existing infrastructure. So you don't need new pipes, you don't need modifications on the airplanes and whatnot. Whereas you compare and take it green hydrogen as an example, there's a lot of questions. How do you store it? How do you transport it? A bunch of energy that gets lost in between and other stuff. And then I think another argument is it's an existing market with a very clear defined profiles, who buys, who pays, and stuff like that. We also looked, as I said, into carbon markets, and carbon markets is much more in the air. Who's going to buy these offsets, for how much, what's the quality? Is that the way to go? And I think these two things just define this market as is, on top of, I think, what colleagues said.
If I'm someone developing a SAF technology or looking to sort of develop a project and I'm very early, what are the things you want to see from me that will sort of make you interested in investing beyond sort of the external sort of market or policy sort of landscape? What are the individual ingredients that I need to have sort of in place to sort of make you think that I would be a good investment?
Yeah, I can start. So one was probably for us is a venture capital fund with 10 years investment period, and kind of chasing these outsized returns is, I think, one which is really important for us is technology being novel and kind of taking that tech risk and potentially then reaping the potential upside. I think a lot of the discussions were how we can take existing technologies and incrementally improve them. I think we look more through the lenses of significantly improving state of art. But then I think what maybe we talked less within the context of this conference is the different team constructs and people that run it. I think one is when you get started on a early stage, taking from lab to first pilot, is really you need a team that has done it before, ideally worked with each other together, knows how to do milestones, does not take any shortcuts and stuff like that. But then I think once you go closer to first of a kind and another, you also need that commercialization acumen. And I think as we look into space, there's a bunch of technologies out there. And honestly, a lot of these technologies, even though being superior, don't get to see the light just because of that lacking commercialization angle. And that goes on to fundraising, be able to convince someone to fund your technology. For example, most probably, if you take Infinium, which is now regarded as one of the most successful, most probably is not the right way, but to tell, but most well-funded is because of the aggressive fundraising capabilities and building an ecosystem around. And again, we're not investor into that, but also convincing airlines to get that on board. Again, as you heard from discussions, people are being reluctant. They're not shooting off takes left and right because you need to really figure out who's that right partner. And then on the feedstock side, commercialization. But I think a lot of it really comes back to the team and how well they can execute it. I think it's a topic less spoken of, but equally important as all other facts.
I'd just add to some of that. I think it's absolutely right, but it does depend on the stage of funding, right? So the earlier stage, team comes into it massively because it's essentially a dream that you've got to buy into, and you're looking at it and valuing it in a different way. But also, it's around the sources of capital. So you said, what's practical for a startup to think about? Well, what's practical to think about is, the company's existing funding. Is it stopping next round of funders coming in? What are their investors' requirements at that next round? And thinking through those aspects. So we see a lot of startups that sort of don't quite understand the mix of money between seed through Series A, B, C, to debt finance. You've heard from all the banks, sitting up here today, there's probably a 10-step, very well-trodden path for getting, project finance, right? And they'll bank on the offtakes, or et cetera, right? So that's all there. At the earlier stages, there's different things that you're looking at, because obviously you're not going to necessarily have those offtakes in place and everything along those lines. But it's really make sure you think about the types of capital you're putting into your business, and it's not restricting you from raising in the next round.
Patrikas mentioned a good point about novel technology. One of the things about venture capital is you want sort of new technology, new ways of thinking about things. But we heard yesterday from all the project finance guys, they won't look at anything below a TRL 7. So how do you go from getting venture funding to develop this new technology to actually moving through the TRL levels whilst also respecting the returns that you want from the funds within the timelines you've got? That's quite hard.
Well, firstly, I would say one of the things is novel's quite interesting. I like the idea. However, a lot of the technology people are putting together has been around for a very, very long time. They're just putting it together in a different way, which is why the TRL is low. So I think that's first thing to clarify is there is not a lot of new, really novel stuff. I mean, a few startups here, it might point to me and say, Glenn, what are you talking about? But
I think they'd all say all their technologies.
Yeah. But I mean, essentially, FT processors, et cetera, they've been around for a long time. They're just put together in a different way.
Yeah. I think people need to understand that the capital markets work in discrete areas. So when somebody talks about something being bankable, as a founder, you need to translate that to, in my spreadsheet, in my Excel cells, every single time I enter a number which isn't a formula, I have to have sheets of evidence to justify why I put in the number 8, not 12, not 2. And that needs to usually be back-ended to some sort of purchase order or something. So when the bank takes the spreadsheet, unpacks it, and rebuilds it, and they come up with an NPV or some sort of valuation of it, there's a higher degree of precision and certainty that they're going to get the yields they need to underwrite the banking loan to it. At the stage where I invest, and Patrikas is saying you're looking for hubris, this undeniable confidence in a founder that they can grow the business and deliver something. They often don't know what they're going to be doing next month, let alone next year, the year after. So the spreadsheet is kind of meaningless in a way. I tend to look at the detail. What are you going to be spending over the period of months that we're going to give you funding for? And are you going to make enough progress that you can raise more money at a much higher valuation? Right? So people evaluate it in different ways, and my job is to price the risk that's going forward to determine how much I should own of that business today to make it worthwhile. It's very different from what a banker or an off-taker would do.
There's two things that you said, Glenn, which I'd like to pick up on. So the integration risk. So we look for a team that has the capability to really manage that integration risk. And then, so what we're doing is investing in project developers. And there's sort of 4 key criteria that I look at when assessing a project developer. And we're primarily focused on the ESAF or biomass gasification end of the spectrum. So the first is, are they in a location where there is a fundamental cost of power advantage? Yeah, that's absolutely critical. That's going to form up a lot of the vast majority of your levelized cost of SAF is going to be the cost of power. So Nordics in Europe are particularly attractive. Are they in a location where they have attractive access to feedstock? So biogenic CO2 or biomass, that's ideally next door or very close proximity. The third is, do they have a management team that knows how to do the early stage engineering and development and commercial structuring in a sound way? And then the fourth is, are they in a market where there is a mandated demand? So Europe being the target market for most of those investments. And those are the kind of critical lens factors that we look at project developers from.
Are you looking at project developers and thinking, wow, this is like a very long lead time, there's a long period of time, you've got to wait until you can get returns? You're kind of prepared to sort of weight that out a bit more as sort of a more strategic than a sort of a pure play sort of VC fund, aren't you?
Yes, so that's the other thing that Glenn mentioned, which is really thinking about the second or the next investment round and preparing for that from the point of making the investment. So what we're trying to make sure is developers that we invest in. So we've got two principal developers. One is a business called Nordic Generation Fuels in Finland. Another is a business called Nova Sustainable Fuels in Canada, which is doing more on the biomass gasification. So when we invest, we're making sure that they're putting in the right stage gate approach to get all the right things lined up. So when we look at bringing in other investors alongside us at the feed stage, when you need 20, 30, 40 million euros of capital, the feed investor that comes in to join at that stage recognizes and agrees with all the work that's been done up to that date. Because the worst possible outcome at that point is for someone to come in and say, I kind of like a few bits of the project, but I need to recycle everything else. And then you just lose a bunch of time and money, and no one's going to invest at that point. So getting those initial stage gate approaches done correctly is fundamental.
Glenn, you're familiar because you're covering the whole landscape. You're not just purely VC, you're looking at sort of project financing as well, so you can be a bit more patient in your approach.
Yeah, I mean, our KPI is 2050, net zero 2050, right? So this is a big challenge, and it's capital intensive, and it's positioning it as there's some quick wins here. It's going to take time, right? These things are big plants. They've got lots of risks. There's lots of downsides to manage. There's lots of unique ways of doing things. So it is going to take time, and you have to be mindful of that with your investors. But also there is an opportunity at every stage of that. I would like to call it like the flywheel, and I think one of the things the industry could do is actually work more on getting that flywheel effect working, which is, how can we do better acceleration for companies to get them going faster, and positioning all of those criteria. How do we then position for sort of venture growth? At that early stage, that Death Valley, which is probably the area that's most underserved at the moment. And then how do you get them round into the infrastructure, debt finance, buyout, exit, etc. piece. But I would add to sort of the comments in terms of, I think there's also partnerships are really, really important in this thing. Technology, so there is an aspect of technology, Heifer is going to cap out, so the PTLs, the e-fuels, the A to Js. I think there's the supply chain. So you mentioned the logistics, but blending this stuff. So people talk about creating SAF. Well, okay, how are you going to blend it? Are you going to be a blender as well? Or are you going to add quite a significant price premium to get the fuel blended? I think there's your commercial traction. You've got your jurisdiction. So depending where you do it, you might have different sources of capital, all sorts of things that need to be looked at in each of the projects.
You mentioned the underserved bit being the growth period that's not actually sort of served as well as it could be. A lot of companies are stuck there trying to sort of navigate that sort of period of time where they're trying to get more money in from investors before they reach FID. Is that, obviously sort of with a vested interest, if you're invested in these companies, it is of your concern? Whose job is it? Is it the job of the bankers to sort of come in more earlier, take more risk? Is it the job of them to get more venture funding to sort of bridge that gap? Governments to come in and give grants to cover the gap? How are we going to fill that gap a bit more from your guys' perspective?
So I don't think it's possible to push the banks earlier than they're willing to go at present. So it is really a combination of equity and grant support. So that's the role we're trying to fulfill to a certain extent, is by investing in making sure that the sort of infrastructure startups make it to the point where they can carry the projects all the way through to FID. And then, the other thing we look for in the team is, do they have the ability to put together the sort of lengthy process you need, the application forms you need to go through to secure a subsidy? It's not straightforward. That can be a multi-month, multi-year effort sometimes in preparing for a subsidy round and securing attractive financing. So those are the two. So equity and grant support at the early stage. I don't think it's possible or the right thing to push banks to go earlier than they're willing to.
I mean, we always try to install to our startups or founders that we talk that, I mean, one has to be super cash conscious whenever they're building these technologies. How much money will it take them to get to the pilot, to get to first of a kind? Because there's just so many limited shots one can take. I mean, if you look into the whole capital stack, there is sure accelerators, which is a small piece of the pie. There's early stage VCs, which are we putting the initial money, funding maybe first pilot, and then following all the way up through the first of a kind. But then if that balance sheet suddenly bloats, and if you look into later stage folks, everyone's asking for revenues, everyone's asking for first of a kind plans already being established. There's I mean, instruments in between. There's Breakthrough Catalyst, which has been doing a great job providing financing to some of these companies. Actually, one of the largest insurance companies in Europe, Allianz, is now trying to dedicate standalone pocket, which would go, I think, even earlier than you guys on Octopus energy generation. So there are these pockets, but I think also to Glenn's point, it's very important not to fall into that valley of death trap. I think there's new funds, there's kind of new logics emerging, but I think one really has to be cash conscious on how they manage, and also whenever you go project development, there's a lot of things you have to make sure that the timeline follows, doesn't slip, that the bill of material doesn't suddenly bloat. And I mean, looking from the outside, it looks all pretty simple, but someone who hasn't done that job before, it's not an easy exercise.
I'd say also one of the key things that in SAF space is the transition of the company between stages as well. So a lot of them start out as tech companies. Tech companies, here's the technology, here's how we do it. You need to turn into a build company to build something. And then you need to turn into an operate company to operate something. And I think that is also need to be considered into the mix.
Or they could sort of build pilot plants, then go into sort of the licensing things. They don't necessarily need the operating bit, per se.
There's obviously that model as well.
But maybe we're gonna touch a bit later, but and not taking too much for the bandwidth. But everyone, I think, wishes, or all the startups that you talk, the kind of dream is that licensing of technology. And again, I think look through the lenses of novel technologies. The reality is, I think, up until you hit TRL 8 or TRL 9, no one is going to license your technology. So eventually you're going to still end up putting some of your own equity, as well as finding a partner to develop your first of these projects, prove the technology, and only then be able to license it. So I mean, that's ultimate, because it's CapEx light, doesn't require additional investments, and it's just royalties that you get. But the reality is you need to get to that bridge to first cross it.
I was just going to add, I think, on the technology point. So we encourage all of our project developers to be technology agnostic, and really, for each one of their projects, study and determine, what is the best combination of licensors and technology partners to work with from the ground up. Because one of the mistakes we see developers making too frequently is making a technology decision too early, and then realizing a bit too late that they've gone down the wrong path. So we absolutely encourage being technology agnostic, but when they do go out and do the study and look at the licensors, if you're looking at taking FID on a project in the next 3 to 5 years, you need to be working with technology licensors that have the balance sheet to be able to stand up behind the guarantees that they're going to offer. So that narrows the pool down quite a bit. I think we're all really keen and excited to see some of the earlier stage technologies progress, but it'll be interesting to see the exit routes they choose to take. And I was having this discussion with a couple of folks over lunch. Often the best route for a lot of the technology developers is to get bought out by a larger house who can then stand behind that technology with their stronger balance sheet.
Do you think, one of the famed instances of what you're talking about is like the issues that Fulcrum had when they were developing technology, realized they had to sort of change tack and it didn't quite necessarily work, and then unfortunately, we all know what happened. Do you think lessons have been learned and understood, and sort of that lessons hit home now, that actually you can't really think of developing a project like that and make even make those changes and not expect it to have a big effect further down the line?
Case in point with Fulcrum, right? That it's no different than any other technology company. It's not unique to SAF either, right? There's part of the role of an early stage venture capitalist is to help de-risk, right? Through our connections, our experience, even cross-portfolio integrations of, we've got 3 industrial biotech companies in our portfolio. Only one of them may be looking at doing a fuel, but there's commonalities maybe in fermentation or something, or they can help solve each other's problem. It may well be that something's going to grow and get to a stage, and there's unforeseen problems they didn't expect in engineering, right? When you get to a certain scale, and then that can translate to an unbridgeable cost. So then your unit economics, your models showed year before and year before that being safe, suddenly becomes untenable. And there's hundreds of examples of that. So it's not unique to this sector. It's just the nature of the beast. If there's a new technology that's come out of university and it's gone through the angel funding and it's gone through that and it's had a little bit de-risking, at some point when it gets to a certain scale, you need the demonstrable unit economics to get the project financing. You just can't get away from that. Even if you're going to be doing the licensing, you've got to be able to prove to somebody to say, if I'm going to get a royalty rate of X, you're going to still be able to make a profitable, viable business out of it. And they still need to have that evidence. So I don't think it's necessarily used. It's just part of technology commercialization itself that there's risk involved.
You mentioned Bilal, about exits. Like, where do you see exits being for venture capitalists? Because we've seen in the US, a couple of people are sort of gone public and are looking to go public and have sort of exited through. There've been exits through that route. There's been sort of, are we looking at sort of M&A, like you mentioned, sort of big tech providers buying small ones? Where do you think the exits are for you guys further down the line?
So I'll perhaps let the others comment on the VC approach, but for us as a growth and infra investor, the route to exit is really getting a project to FID or as close to FID as possible so that it's attractive for even mature pots of infra capital, some of which we do manage ourselves, to then come in and say, this is sufficiently de-risked for us to be able to take this on. So that's the route to exit for us, really. I don't think it's possible to sell a project even at the feed stage and start to get money out of it until you've de-risked it a little bit further. And one of the other sort of golden rules of project development that really, really important is to not let the sort of technical get ahead of the commercial. So you could take a piece of land or a concept and go and spend 20, 30 million on a feed study today. You could do that feed study. It's not really going to actually deliver value for the platform or for the business if you haven't got your commercial set up right. Have you got your grid connection? Have you secured the land? Do you have a viable route to market to get your molecules out? So getting those commercials running in parallel with the technical work, or running ahead as much as possible, is really, really important. At least the ones you can control.
Yeah, I mean, we've seen a big announcement from some of the colleagues that were speaking on the stage today. Honeywell acquiring Johnson Matthey Technologies. We've seen some stuff on Carbon Journal side of things. So Carbon Engineering bought a couple of years by OxyCU. Sorry, not by Occidental. Not OxyCU.
Andrew's shocked somewhere in the room.
So there's ways. I think that the kind of biggest benefit of this market is that if we look into novel technologies, it's so strategic, and a lot of people are now kind of sitting on the sidelines and deciding where to put infrastructure money, and even the kind of big oil and gas guys are like, okay, where are we gonna put that money? So I think there's that logic of acquisition. Again, question when that happens. Is it TRL 8, TRL 9? Public markets, I think it's a big question, not only in the context of sustainable aviation fuel, but broader kind of venture capital, and how money has been, and value has been more accruing in the private markets over the past couple of years versus public. And how is that going to change? Most probably nobody knows. But I guess at least on any kind of climate tech, deep tech side of things, we yet to see how this stuff is going to go, and there's only been a handful of cases to talk about.
Look, I think for any exit to happen, I mean, okay, there's always the outliers like OpenAI and the people that can't. You need to prove the unit economics. You need to demonstrate you can get a viable route to a positive net margin business that's attractive to somebody else. And then there's multiple different routes to do it. We've already said that somebody wants new enduring capability that they currently don't own, they don't know, which I think SAF kind of falls into that for a lot of the oil and gas majors. But equally, you've got private equity investors, you've got the infrastructure funds who say, we'll take this at a relatively low cost and then we can employ several billion of this scaling out where we need to be. And then once we've run that for a few years, flip that, we'll know that. And it's different models. So it's not just IPO or trade sale. There's multiple routes to doing this. Key to all of them, though, if you want to do that and have a decent return, is that company needs to be able to demonstrate good, strong unit economics. It's no different to any other sector. Right?
Yeah, I couldn't disagree with anything that the panel said, but what I'd add to it is there is other sources of capital around that might be also been not looked at, and I haven't heard much talk of it, is like big family offices, net worth. And the reason I say that is, like, if you speak to a lot of those family offices, they don't want to be the one that screwed the planet, right? And there's some actual aspects there which they may be in for a lot longer term, prepared to take a higher risk, and therefore, not looking for that quick multiple exit that some of the earlier stage investors might be looking at. So I would think, to start to think about looking at those different sources of capital. But I think that, what everyone said is essentially at each stage, there is a different set of IRR that the investor's looking for. So, the IRR of debt financing is a lot less than what a VC is going to be looking at. So, and a VC might not even be looking at IRR, it might be looking at multiples, right? And so you've got to sort of think through that, one of the things that we always ask the startups is, show us your funding timeline, right through. Show us all your exit paths and how you're going to clean up the cap table at certain points during those funding, because it's really important, because actually some of the senior, when you get into senior debt and that they don't want some of the small stuff in, or they'll be diluted out, and that's not good for anybody. So it's getting a thinking through of how that looks right through the project, and that's quite hard for some people because they don't really understand it, but they need help there.
That was going to be my next question. Do they actually understand the significance of that and be able to sort of understand why that's important and why you need to see that?
I don't think, look, if you're a founder and you've never done it before, getting your head around cap tables and the legals and preference stack and all these things is pretty difficult. I think that one of the challenges, I think, especially with the hubris you see in people, is they see everything through rose-colored spectacles, and so they usually run out of money quicker than they want to. And so it's really saying, actually, if you think you need 5 million, don't forget, stuff happens out of your control, which allows you probably might be 7 or 8 months late, and it's got nothing to do with you and your team. It's just a partner, change of management, something happened, it's the delay. And then you don't want to run out of money before you've hit a milestone, because nobody will see there's been an increase in the value in what you're doing. So you need to wait, figure out, allow for slippage, allow the time for the milestone, and then allow at least 10 months to go and raise the money, because it takes a long time to raise capital. So they probably need 18 months more cash than they actually think to begin with. And then it's thinking along what Glenn just said is, okay, once you've got that, what's the next round going to look like? So what milestones you're going to have hit to get the uplift you need to raise that amount of capital? It's a really complex question to ask a founder sometimes when they basically haven't got a clue.
No, and also don't underestimate culture. So yeah, as you bring strategic investors in, you're talking to corporates. Corporates don't move fast. Startups move very fast. Like, yeah, we'll have a meeting tomorrow. That could be 3 weeks to get a meeting into a corporate with all the right people, right? It's just reality. Corporates are very slow. Some are much better, but in this essence, that looking at your finances and saying things will take longer than you expect at different parts of that journey.
Someone's asked you a question, Glenn, about what the IRRs expected at different stages are. You going to comment on that?
Set yourself up for that one.
Yeah, I know. No, I think, look, I would say earlier stage, you're probably thinking about multiples of your capital you're putting in. So and anyone can use a ChatGPT or a Google, quickly will get the understanding of the mixes there. As you get up to later stages, debt financing, that's very clear as well. So, it is a range. That's what I'm saying. It's a range, and people are looking. Their capital is at different risks at different stages, and so there is different IRRs or different multiples at each stage, and there is a range, and really that is, individual LPs. It might, as I said, a family office might be prepared to take more risk, lower IRR, because it's about, well, actually, I want to do something that's giving back. A VC might have a different angle, which is, my LPs or the investors that they've got to return to need an exit in 5 years. So they need to show a multiple. Some of those are going to be high risk, so they'll fail. So they need to have lots that return. So it's a political answer, but it's hopefully makes it a bit clearer.
But perhaps to sort of comment on the other end of the spectrum, what is the lowest possible IRR? I think if you've got a project that's ready for FID, that's got a long-term offtake agreement, it's got all its contracts secured, land, grid, etc., everything fully de-risked, and what you're asking investors to take on at that point is primarily construction and commissioning risk, you're still going to struggle to get below a double-digit, a low tens return expectation. I think that's the lowest possible that's available on the market today.
10 to 12.
We got one final question, and I guess you could basically boil it down to which one's got the best odds of reaching commercialization, and you're not allowed to say heifer.
No, I'm not going to answer the question directly. I think what we need is multiple different shots on goal. Right? From the venture standpoint, we're never going to invest in anything if we don't think it's got that chance of being commercialized. What we're not going to do as an industry is back one single technology. Even in some funds, I think, Glenn, you're very specifically in SAF. You can probably do multiple different shots. But we as a fund probably might only do one, perhaps two, to limit the amount of reputational risk of conflict of interests. But we need multiple different shots on goal that have multiple different capital stacks and costs that we don't know.
I mean, look, I think it's twofold. One-fold, what is very beautiful about this is that the market is large enough to have multiple technologies happily living with each other and selling into market. Short term, there's been a lot of discussions about the price point. Maybe that price point today is not of a kind of big matter as everyone's rushing and there's let's say supply squeeze. But then I think long term, really the winners are, or at least to our view, the winners are through lenses of venture capital investors, the ones that manage to get to that, let's say not parity, but as close as it gets to that parity, whatever that technology might be.
I would say it's really dangerous asking that question. I can see half a dozen of the startups in the room. So, I think that, in terms of which technology wins, you've got to look back at the whole pathways. This isn't SAF. The conversation is all about SAF. We're we're sustainable aviation, right? It's not just sustainable aviation fuels. There's, next gen propulsion. There's ground operations. There's navigation. There's, carbon. There's a very interesting point around, the cost of carbon and how carbon can come into this, and carbon generating high quality, long-term permanent removals or feeding back into a fuel, an e-fuel. I don't think there is an answer to that question. It's going to be based on GHG score and getting to that net zero. If you ask any of the airlines, they'll say, we've set targets that say that we will get to net zero. They will prove it, and they'll prove it whichever technology gets them to that route.
Maybe just, 100%. I think this is a good point. I mean, one is everyone looks into SAF, looks into e-fuels, and they're like, hydrogen is expensive, carbon is expensive. I think another way to look is You look at the novel hydrogen technologies. How can you get the cost of electrolyzer lower? How you can invent new electrolyzers? So I think there's a lot of ways to look at it.
Right, I think we've run out of time. So, gents, thank you very much for that discussion. That was excellent. Round.